Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. And earlier today, I was talking to Harry Nimmo, who's the manager of Standard Life UK Smaller Companies Trust. And we were talking about smaller companies and the state of that market.
One thing I've learnt is that experience counts for something in investing, particularly smaller company investing. You have to make judgments on a lot of different companies, a lot of different individuals, and if you're new to it, it's more difficult. If you've seen it before, you can make better decisions. I've also learnt that investors like, and also it makes a lot of sense, a predictable process. Stick to simple rules, simple repeatable rules that provide a client experience that is not unexpected. Clients don't like the unexpected, they don't like bad shocks. They also prefer, whether they say it or not, lower levels of risk. We invest in smaller companies in a lower risk way. We provide a modicum of resilience into what is seen as sometimes quite a risky asset class. And simple rules like lower risk investing means better returns. High risk investing means poor returns. That flies in the face of the academic research, but my experience suggests that low risk is better than high risk. The differential occurred after the election. You can see it almost from on the 7th of May. Unexpected Conservative victory with a working majority. That meant a continuation of what has been successful economic and financial management of the UK, at least in the eyes of business. And we can expect that to move forward. Kerry at the Bank of England. The UK economy is performing better than almost any other country in the OECD. There are not the issues we're seeing in China or Greece or with the euro or emerging markets. The UK is seen as a haven of stability, and quite honestly, in the last 3 or 4 months, I've never seen as many of our holdings reporting earnings better than expectations. The consumer spending environment is very good. It's spreading down into the mass market. Wage levels are moving up slightly. That's good for consumer spending as well. I think they're pretty good. The last 5-6 years have been fantastic. 20% per annum for the last 5-6 years for the average smaller companies fund, or getting on for that, certainly in the teens. I think for the next 5 years you can't expect to have it all quite your own way. It's going to be low teens, nearer 10 than 20. We're at the later stages of an economic cycle, an economic upturn, and you've got to be realistic about this. But one thing's for certain, smaller companies are going to do better than larger companies over the next 5 years. Larger companies have very real issues, structural issues in the sectoral makeup of that market, and over the very largest companies to achieve growth. They really struggle there. Smaller companies can grow much more quickly, and they will over the next 5 years. We follow a screening process. We have a matrix, so we go very much from the bottom up, but we do find subsectors of the market that are very, very attractive, and one of these is in software for financial regulation. There are a couple of companies that we're invested in this. One, First Derivatives PLC, based in Newry, Northern Ireland. They provide software that tracks down market manipulators, that finds insider dealers. There's an obsession with this right now amongst regulators, amongst exchanges, and also within firms, within financial institutions that manage these funds, making sure that risk is kept under control and monitored very closely. So that's one area. Another area is actually in the listed financial advisor sector, a couple of stocks, Mattioli Woods, Brooks McDonald. That industry, I think, is coming of age. It's much more professional. It's more heavily regulated. The small players are out, are leaving the industry, and there are various major benefits in terms of extra freedoms to manage one's own pensions. Pensions changes are also driving this industry. A third area, if we've got time, is in the taking government interactions with individuals online. Just think, if you're buying your council tax, your parking permit, paying your income tax, all sorts of things like these are being digitized. They used to be paper-based processes, and now the interaction is online. And the government is really using smaller software data service companies to develop these functional groups and interactions. And a good example of that is a company called Kainos, again based in Northern Ireland, coming out of Belfast University.
That was Harry Nimmo. Now, Harry believes it's impossible to time your entry into smaller companies. You need to be a long-term investor who's there, comes along for the ride and gets the benefit. Thanks so much for watching today.